You're about to make the biggest purchase of your life, and one wrong move could cost you tens of thousands of dollars. Picking the wrong mortgage type is exactly that move. Most buyers never even realize they had options. Nobody tells you this part. There are 4 main mortgage types, and the bank often nudges you toward the one that's best for them, not you. The right loan depends entirely on your specific situation. Your choice really comes down to 4 things: your credit score, how much you've saved for a down payment, whether you've served in the military, and where you plan to buy. Get those clear, and the right loan reveals itself. Why does this matter so much? Because the difference between these loans isn't small. It's the gap between $0 down and tens of thousands. It's paying mortgage insurance forever versus dropping it later. This is real money. Think about it. On a typical home, the wrong mortgage insurance setup alone can cost you over $100 a month for the life of the loan. Stretch that across 30 years and you're looking at a small fortune lost. So we'll break down all 4, one at a time, in plain English. In a few minutes, you'll know exactly which mortgage fits you and which ones to skip. We'll start with the one most people end up with. Loan number 1, the conventional loan. This is the standard, plain vanilla mortgage. It's not backed by the government, which means the lender carries more risk, so they want proof you're a safe bet before they hand over the cash. Conventional loans usually want a credit score around 620 or higher. The better your credit, the better your rate. If your score is solid and steady, this loan often becomes the cheapest option over the long run for you. Down payment surprise, you don't need 20%. First-time buyers can put down as little as 3%, and most people land somewhere between 5 and 20. But putting less down triggers something you need to understand. That something is PMI, private mortgage insurance. Put down less than 20% and you pay it monthly. Now the part that makes conventional special, once you reach about 20% equity, you can have PMI removed. That removable insurance is the whole appeal. With conventional, the extra cost isn't permanent. Pay down your loan or watch your home value rise, hit that equity mark, and you drop PMI for good. This loan rewards good credit. Now loan number 2, the FHA loan, backed by the Federal Housing Administration. This one exists for a reason. It was built for buyers with lower credit scores or smaller savings who'd get turned away from a conventional loan. The numbers are forgiving. You can get an FHA loan with just 3.5% down if your credit score is 580 or higher. Even with a score between 500 and 5799, you can qualify with 10% down. That's the door opener for so many first-time and credit-challenged buyers. If your credit took some hits or your savings are thin, FHA might be the only loan that says yes to you right now. But there's a real catch. The catch is mortgage insurance, called MIP. FHA charges an upfront fee plus a monthly premium. And the painful part, on most FHA loans today, that monthly MIP lasts the entire life of the loan. It doesn't fall off. Read that twice because it's the key difference. Conventional PMI can be removed. FHA's MIP usually cannot unless you refinance into a different loan later. So FHA gets you in the door, but it can cost more over time. Now for the best deal in the entire mortgage world, if you can get it. Loan number 3, the VA loan, backed by the Department of Veterans Affairs. If you served, this benefit could save you a staggering amount. Who qualifies? Eligible veterans, active duty service members, and some surviving spouses. If that's you, pay close attention because the terms are genuinely hard to beat. This is one of the most powerful benefits of military service. So why is it unbeatable? 0% down, meaning you can buy with no down payment at all. No monthly mortgage insurance, ever. And competitive interest rates on top. There's simply no other loan that stacks up like this. There is one cost, a one-time VA funding fee, but you can usually roll it right into the loan, so it's not cash out of pocket. And if you're a disabled veteran, that fee is often waived completely. Incredible value. If you qualify for a VA loan, in most cases you should take it. Full stop. It's the rare deal where the best option is also the simplest. But not everyone's served, so let's look at one more powerful option. Loan number 4, the USDA loan. This one's a hidden gem most buyers have never heard of. It's designed for low to moderate income buyers purchasing in eligible rural areas, and some suburban ones too. Don't dismiss it before checking. The headline perk matches the VA loan, 0% down. You can buy a home with no down payment and enjoy low interest rates. For the right buyer in the right place, this is a genuinely amazing path to ownership. But USDA has 2 gates you must pass. First, an income limit, since it's aimed at low to moderate earners. Second, the property must sit in a USDA-eligible location. There's a free map online where you can check any address. USDA does have its own guarantee fees, similar to mortgage insurance, but they're generally lower than FHA's. So if you qualify on income and you're buying somewhere eligible, USDA can quietly be one of the best deals around. Now let's compare them head-to-head on the 4 points that actually matter, so this all clicks into place. Down payment, credit requirement, mortgage insurance, and who each one is truly best for. Here's the cheat sheet. Down payment, VA and USDA both let you put 0 down. FHA wants 3.5%. Conventional can start at 3% but often needs more. If saving a down payment is your wall, VA and USDA crush it. Credit score, FHA is the most forgiving, accepting scores as low as 500 to 500. Conventional wants 620 or more. VA and USDA don't set strict national minimums, but lenders usually look for fair credit. Know where you stand. Mortgage insurance, the big one. Conventional PMI can be removed at 20% equity. FHA's MIP usually lasts the life of the loan. VA has none at all. USDA has lower cost fees. This single factor can decide everything. And who each is best for? VA if you served, USDA if you're buying rural and income eligible, FHA if your credit or savings are low, conventional if you've got solid credit and want to ditch insurance later. Let me prove how big this is with real stakes. The VA loan program has guaranteed millions of home loans for service members, saving veterans countless billions in down payments and insurance they never had to pay. That's life-changing money. And FHA? It's helped tens of millions of Americans become homeowners who'd otherwise have been locked out entirely. These aren't tiny niche programs. They are massive engines of homeownership, and one of them is likely built for you. So how do you put all this to work? It's simpler than it sounds. You're going to run yourself through a quick 4-step filter this week and it'll point you straight at your best loan. Grab a pen, follow along. Step 1. Did you serve in the military? If yes, look hard at the VA loan first because it's almost always the winner. Don't even compare the others until you've confirmed whether you qualify for this one. Start here. Step 2. Are you buying rural with a modest income? Check the USDA eligibility map online for your target address. If both boxes tick, USDA's zero-down deal might quietly be the smartest move you'll ever make. Check it free. Step 3. Is your credit under 62,000 or your savings thin? Then FHA is your friend. Just go in knowing the MIP sticks around. Step 4. Got good credit? Choose conventional and aim to drop PMI down the road. Consider this your permission slip. You don't need to be a finance expert to get this right. You just need to match the loan to your life. Thousands of regular people do it every single day, and so can you. Fast rundown. Conventional rewards good credit and lets you drop PMI. FHA opens the door with low credit, but the MIP lingers. VA is the unbeatable zero-down deal for those who served. USDA is the rural zero-down hidden gem. Match the loan to your situation, and you could save tens of thousands over the life of your mortgage. That's not a typo. The single smartest money move many buyers make happens before they ever pick a house. So a question for you, which loan fits your situation and which one surprised you most? Tell me in the comments, I read them all. If this made mortgages finally make sense, like, subscribe, and share it with someone buying soon.